Matt Orton as well on the show with us. Matt, hi, good evening to you and, well, morning here. But do you think that's the right thing to do? Do nothing at all?
Hey, good morning, Aisha. And I fully agree. I think for the Fed in particular, they've already cut 100 basis points of the effective 4 rate cuts. When you look at the inflationary data contextualized with a fairly strong economy, not real cracks happening in the labor market, and question marks with respect to fiscal, what's going to happen on the fiscal side of things, why not wait? There's no urgency to cut rates right now and let the data come in. And I think the market's going to be very keenly focused on the next few CPI, PCE prints to see if we're starting to make some progress, particularly with respect to shelter inflation, which has been a really, really sticky component. So I think nothing happens tomorrow. And I think Powell is going to do his best to basically say absolutely nothing useful at all. I think he's going to try not to be any more hawkish than he was in December, but I think he's also going to try not to appear dovish in any way, shape, or form and really emphasize data dependency.
Matt, what is stopping Fed to move? There is enough and more data point which now seems to be indicating that a rate cut is something which will only help the economy. It will calm the bond yields and it will ensure the unnecessary strength which is getting created in the dollar. That also, fades away because US cannot afford to have a strong dollar and a spike in yields.
Yeah, Nikunj, that's a very good point. And I think, that's something that Trump will probably hammer home when the Fed doesn't do anything, even though that's widely expected. And it's almost a self-fulfilling prophecy because one of the biggest issues with the inflation story is housing. And housing remains so expensive because of where mortgage rates are and the impact that has both to existing home sales and new home construction and new home sales for first-time home buyers. So if you cut rates and rates start to come down, perhaps that then feeds into the mortgage market and it creates a self-fulfilling cycle. But the other hand of that is then perhaps inflation expectations, which have been fairly well anchored but have started to rise a little bit. Do you lose control of that? So I think it makes sense to wait, at least right now. And by March, you're going to have more data prints available with respect to really say, okay, even if inflation progress is very slow, we're still moving in the right direction. And I think the bias will be towards making a cut because I don't think inflation is overheating. And hopefully the data will support that. And that'll keep this engine of US exceptionalism, I think, firmly in focus for investors.
Do you think the Trump pressure would work at all? Because Trump obviously would love them to act faster and sooner and, make it known to the world as to what direction they're headed in.
Yeah, he would. I'm not sure how much effect he can actually have on the Federal Reserve. Maybe he has an impact on behavioral decision-making or playing into the backs of the minds of some of the Fed officials. But I think overall, we have to really just watch the show unfold as an investor. And when I came into this year, really for the better part of the past 5 or 6 months, I've been telling clients that we're really moving into a higher volatility bull market. The fundamentals are still there, particularly in the US. You have very good and improving earnings growth that's broadening across a number of sectors. You have a strong economy underneath, and even if it slows a little bit, it's still well above trend. So that's supportive of a cyclical trade. But what you don't want to do as an investor is chase any of these opportunities. If you were chasing AI in November, December, yesterday was especially painful. So let the market come to you. There's going to be a lot more updates, a lot more volatility with respect to policy in the coming month or two. So there's going to be chances for investors to get in. Perhaps yesterday was that chance on the AI trade. I think so, in some high quality names. But again, let the dust settle, move your chips into high quality investments that play those secular growth themes, but don't chase on the upside because you will get a chance in this market to come back in.
Matt, final question. And in India, all of us are scratching our heads trying to understand that foreign institutional investors who loved India, where are they now? When will they come back? Where are our good friends?
Yeah, I think a big part of that, well, I'm still active. I think there's a tremendous amount of opportunities in India. And what's very interesting is I've done a lot of travel to meet with clients, both in the US and around the world over the past 2 months or so. And India comes up in a lot more discussions because when we start talking about the opportunity from a global perspective, particularly in the emerging market complex, India looks much more attractive from demographic secular growth trends than does a China, than does a South Korea or some of the other markets. And so I think if we can start to see some weakness in the dollar, which is going to get asset allocators to want to make a move into emerging markets, I think India will be a disproportionate winner of that trade, especially if we get some constructive news from the budget, which makes it seem like we're going to resume GDP growth. And earnings season so far has been, good enough. It's not showing many further cracks. So that's a good constructive development. So I think if we wait another quarter or two and you see weakness in the dollar in either a sideways or slightly upward consolidation phase through the overall market, I think that really gets the attention of investors because they are looking for opportunities to diversify portfolios.
Okay, Matt, so good having you on the show. Thanks for your time this morning.
Thank you.
If you like this video, then like, share and subscribe to ET Now.